Are you about to make one of the most expensive tax mistakes when selling your Manhattan property? What most sellers don't realize is that misunderstanding capital gains tax in New York City could cost you hundreds of thousands of dollars in unnecessary taxes. Here's what makes our approach different when it comes to capital gains tax in Manhattan. Obviously, you need to understand the basic rules. However, what really matters is having a strategic plan before you sell. We found through experience that sellers who plan ahead can often save significant amount of taxes. It is extremely important to know your options, but also to make sure to get professional guidance, tax advice well before we list your property. Let me break it down for you, because after helping hundreds of Manhattan homeowners navigate these waters, we've seen the costly mistakes that happen when sellers don't properly plan for capital gains tax. In fact, with New York City's combined tax rates potentially exceeding 30%, this is one of the most critical aspects of your sale that we need to get right. In this video, we're going to cover exactly what you need to know about capital gains tax when selling in Manhattan. I'll walk you through the rules for both primary residence and investment properties, show you how to qualify for the maximum exclusion, and reveal some strategic options that could help you minimize your tax burden. Let's start with the good news for primary residence owners. If you're selling your primary residence in Manhattan, you may qualify for a significant tax exclusion. For single filers, you can exclude up to $250,000 of your capital gains from taxation. And if you're married filing jointly, that number doubles to $500,000. Here's a real-world example to put it in perspective. Let's say you and your spouse bought a Manhattan home for $800,000 and are now selling it for $1.2 million. In this case, your capital gain would be $400,000. Because you're married and this gain falls under the $500,000 exclusion limit, you likely won't own any capital gains on this sale. However, and this is extremely important, you must meet specific qualifications to claim this exclusion. First, you have to have owned and lived in the property as your primary residence for at least 2 out of the last 5 years before the sale. These do not have to be consecutive years, but they must total 24 months. Additionally, you can't have used this exclusion on another property sale within the last 2 years. Now let's talk about investment properties, because this is where things get a little more complex and where we see sellers make costly mistakes. If you're selling an investment property in Manhattan, you will not qualify for the primary residence exclusion that we just discussed. Instead, you face a significant tax burden that requires careful planning. But here's what many sellers don't realize. You also owe New York State tax, which treats capital gains as ordinary income with rates ranging from 4 to 10.9%. Plus, New York City adds its own local tax of up to 3.876%. When you combine all these rates together, your total tax burden could exceed 30% of your gain. Let's put this in perspective with real numbers. If you've purchased an investment property for $1 million and sold it for $1.5 million, your capital gain is $500,000. At a combined tax rate of 30%, you may own up to $150,000 in taxes. This is why proper tax planning is crucial before you sell an investment property. There is a powerful strategy available for investment property owners called the 1031 exchange. This provision of the tax code allows you to defer paying capital gains tax if you invest the proceeds into another like-kind property. But there is a catch. There are strict rules and timelines that you must follow. With a 1031 exchange, you must identify potential replacement properties within 45 days of selling your property, and you must close on the new property within 180 days. You also need to work with a qualified intermediary who will hold the proceeds from the sale. Now, the 1031 exchange is not a strategy for everyone. But for the right situation, it can be an extremely valuable tool preserving wealth and growing your real estate portfolio. One critical point that is often overlooked: if you're considering a 1031 exchange in Manhattan's competitive market, you need to start planning well before we list your property. We've seen many deals fall apart because sellers waited too long to begin their replacement property search, or they didn't understand the strict timeline requirements. Let's recap the key points about capital gains tax in Manhattan. For primary residences, you may qualify for a $250,000 or $500,000 exclusion if you meet the ownership and use tests. For investment properties, while you face higher tax rates, strategies like 1031 exchanges could help defer those taxes if properly planned for. Remember, the Manhattan real estate market moves quickly and tax laws are complex and they're always changing. The most successful transactions we see are those where sellers plan ahead and work with qualified tax professionals to develop their strategy before we ever list your property. If you're thinking about selling your Manhattan property and want to ensure you're making the most tax-efficient decisions, let's talk. We work with trusted tax professionals who can help you strategize before you sell, so there are no surprises at the closing.